I've personally closed countless 15% down DSCR loans for investors over the years. Most properties are not going to qualify for the minimum 15% down payment. In this video, we're going to explain exactly why and exactly what you would need to look out for before your offer ever goes in. I want to be clear, 15% down is a real program for DSCR. It is the bare minimum allowed for a minimum down payment requirement for a debt service coverage ratio loan. Lenders love to advertise this program, make it seem a lot more simple than it is. It is a real program, but there's certain things you have to look out for. The biggest one being you have to have a 1 DSCR ratio. Of course, this is where the rent completely covers the mortgage payment after taxes, insurance, and if an HOA is applicable. The reason most properties are not going to qualify at 15% down is because the payment is going to be that much higher as opposed to 20 or 25% down. So if you're looking at 15 properties, you might be able to find one or two of that mix that actually qualify for 15% down. This is why it's really crucial to do all of your homework up front, work with an investor-friendly realtor who's going to crunch real numbers that are going to hold up once you get that appraisal back. The appraisal itself is going to play a crucial role with this DSCR loan because that rent is going to make or break the loan. It's going to make or break the approval. If you're shy of a 1 DSCR ratio after you get that 1007 rent schedule back from the appraiser, you have to pivot to a 20% down or a bigger down payment to get your ratio to be over a 1 DSCR ratio. One amazing hack that a lot of investors really don't think of, if you get that appraisal back, that 1007 rent schedule shows the rental income a little bit under where that PITI full mortgage payment is, a couple of tricks you can do is buy down your interest rate to get that payment a little bit lower where you're going to be at that 1 DSCR ratio. A couple other ideas is you can lower your home insurance by temporarily increasing your home insurance deductible. After closing, you have the right to change your deductible and bring it back to a more standard amount. But by temporarily raising it, you can get your home insurance premium lowered to get that insurance component of your payment a little bit lower to get that 1 DSCR ratio. So overall, the biggest tricks you can take advantage of is you can put more down. You can buy your interest rate down to get that payment lower. You can raise your home insurance deductible to get that insurance premium down. Of course, that payment down. One other trick you can look at is you can raise the prepayment penalty on the DSCR loan to get a lower interest rate. So for example, if you were under contract and you have a 1 or 2 year prepayment set up with your lender, you can pivot to a 3, 4, 5 year to get that interest rate a little bit lower to make sure that debt service ratio is going to service. Let's take a look at a live example of a property that's actually still listed for sale and compare the 15% down to a 20% down DSCR to see how our ratios look. So the property for sale is 526 South Mesa Drive. It was listed for $358. So with 15% down, as you can see, the full PITI payment came out to $23.60 a month. And for 20% down, that payment came down to $21.70 a month. We found on housecanary.com that the market rent was $22.50. So as you can see here, on the 15% downside, we're not going to have that 1 DSCR ratio. With 20% down, of course, we're good to go. We're just over that 1 DSCR ratio. In this example, you can see right in front of you, perfect example of a property not qualifying with 15% down, qualifying with ease with 20% down. So depending on your market, depending on the long-term rents in your area, this is going to make or break the 15% down. This is why having that realtor who's going to crunch accurate numbers for you in advance is really going to help make or break the entire thing by having that DSCR ratio reviewed and analyzed before the appraiser ever goes out to the property to make sure that you're not wasting your time. One of the more underrated components of the 15% down DSCR is there's no PMI. There's no private mortgage insurance. With a conventional loan, 15% down, there's always going to be private mortgage insurance. So the interest rate for a 15% down, of course, is going to be higher than a 20% down. Once you factor in that the lender is not charging any PMI at all, it really enhances the overall offer and deal you're getting with that 15% down. Of course, it allows you to put a smaller down payment on the property and scale your portfolio by more properties because you're not tying up all of your cash with one property. Many property types are going to have a much easier chance of getting that 1 DSCR ratio with a smaller down payment like 15%. From my experience, I've seen dozens of investors I've worked with over the years that have purchased multi unit properties, 2 to 4 unit, with 15% down because those properties are going to have stronger rental income than a single family property. Single family properties can still be great. Again, this is going to vary a lot from market to market. There's some markets where it might even be a non starter on thinking you can get a 1 DSCR ratio, while others, it's going to be more or less a 50-50 chance depending on the property. Condos can be tough because you're going to have those bigger HOA fees that are going to push up that PITI payment. So condos can be tricky. Townhouses can be harder too with those HOA fees. Unique properties or properties that are in rural areas, right? That log cabin that doesn't have a ton of comps, those are properties that are going to be tough to get accurate rental income when that appraisal comes back. Overall, the more data you have relative to the properties in the surrounding area nearing the subject property that you're purchasing, the easier it is getting a DSCR ratio of 1 on 15% down. Overall, the 15% down DSCR is definitely not a gimmick. It's a real program. I've seen investors close time after time. Important to note, most properties are just not going to qualify for this program. You're going to have excellent, robust rental income to make the numbers work. So it's great to have that backup option in place. Can you pivot to 20% down? Can you buy the interest rate down to get that payment a little bit lower to cover that 1 DSCR ratio? I just posted a video on my channel of DSCR specific to 2 to 4 unit rental properties. Any other questions at all, any scenarios you want me to run, drop me a comment, shoot me a message. My name's Austin Clarence. I'm your DSCR loan expert.